Everyone, welcome to PCP 2.0. It's finally here. Today we are going to be talking about what is day trading. Now, it's not just a simple concept of, oh, I know we're buying and selling, right? It's not that. There's more advanced concepts and ways to define day trading. So today we are going to go open the floor up to what I think you should be thinking of when it comes to day trading and certain things like that. I know some of you guys might be like, dude, this is a very basic concept. I know. That's why this week we are going to be going over basic concepts. Sometimes there will be golden nuggets that you guys can pull out of these lessons before we move on to advanced concepts. So, this is the foundation of trading. You guys need to build a healthy foundation when it comes to learning, because if you learn off a poor foundation like I did, if you guys remember my story of learning trading, I watched 100 different YouTubers, tried to find the best one, but I ended up watching like 50 different guys, and they all were teaching different strategies, different concepts, different ways of trading, different approaches, and that foundation was very cracked because you just can't put it together properly. For example, that's like taking tons of scraps. If you guys work construction, you take a bunch of scraps from old construction projects that you guys had going on, and then you try to build something from it. Well, you might be using 2x4 in one project, 1x2 in another project. So then if you try to nail it all together, screw it all together, it just doesn't look right. And that's kind of like the foundations when it comes to trading. If you don't have a healthy, proper foundation, it's going to look like crap. Your trading's going to look like crap. So that being said, what is day trading? Well, so the history of trading is pretty cool. People can date it back to the 1800s or the 1600s of the Dutch East India Trading Company. I don't need to go into the history of that. However, that's when they established the forex or the futures market in certain markets for you to be able to invest in. But when I think trading became popular, is well in 1867, the first ticker tape was created. Now, ticker tape was revolutionary because now you could track your investments based off of a telegram message being sent to a ticker tape, and it prints out the price of stock. Now, when Ralph Nelson Elliott created the Elliott wave theory, this is all the guy had to study years of data, something like this. And he had to dot each point in order to identify common setups, common emotional traits within charting that we still use to this day. Now, that's not Ralph Nelson Elliott. I don't know who that is. So that's it. And then in 1920 is when it started to really pick up, and it got more popular as the advancements of technology happened. Now we know it's getting more and more popular day trading because back in the 90s, when I visited the New York Stock Exchange, the gentleman giving me a tour was a trader on that floor for several years. In the 90s, he rented a chair there for $33,000 a month. Okay. Now in 2023, $30 later, or 30 years later, how much do you think that same seat costs to rent? Okay. So it's going to shock you guys. Actually, $2,800 a month. 2,800. So for less than my mortgage, you can go rent a seat at the New York Stock Exchange. And the reason why it's 90% cheaper is because trading is more popular now. You don't need to be a fancy guy in a suit, in a tie, and that lives in New York City and rents a chair at the New York Stock Exchange. No, not at all. You can do this at home like all of us are doing. I'm pretty sure none of us are currently at the New York Stock Exchange right now. And so trading was revolutionized. It got super popular in the early 2000s. My accountant told me in the dot-com bubble, everyone was trading. That was before circuit breaker halts were a thing. If you don't know what that means, we will talk about it in the future. But that's the history of trading. That's how we got to where we are at now. Now, it's important to know that we want to know the history because history tends to repeat itself. Now, we have to look in the future and go, okay, where is the trading volume going? Because we've had a lot. In 2022 there was a significant decrease in trading volume compared to 2021, and a lot of it was stimulus checks and COVID was finally over. People were back to work, and so the goal is having when something happens in the world to make it so where more people have more money in their pockets, such as a good economy, low interest rates, and for some reason people now can do it at home. Hence technology. We have more trading volume. Okay, and more trading volume means more opportunity, which means more money for us traders. Okay, so that's the history of day trading. Now, moving on, the difference between trading and long-term investing. Trust me, I've talked to about 5 gentlemen now that are probably over $50 million net worth. Um, in the past 2 to 3 months, just in my local area, and just about none of them, except for one guy who, ironically, the one guy who was the richest of them all, was encouraging about trading, and he actually trades. He calls it his fun portfolio, and it's about 300,000. And he showed me it's 300,000 now, but he was down on some stocks. But anywho, so some of those guys are in their 80s. In fact, I think the youngest one's about 75. Now they're all long term investors waiting for that large payout. It's obviously less risky, but unfortunately, you have to wait to sow what you reap, I guess, till you're in your 70s or 80s. So for me, I like to compound my wealth quicker than that. And the reason why you can do that through trading is because you are not trading. I assume none of you guys are trading with $5 to $10 million right now, or $20 million. And everyone's like, "Well, if trading's so popular and you can make so much money on it, why can't you day trade it?" Well, there's actually a rule. I don't want to get too deep into it, but if your fund is over 150 million, now that I'm dabbling in hedge funds, I'm finding you now have to have what's called a prime broker. Therefore, it's not as easy as buying and selling like we can as individual traders. So it leaves us a huge advantage when it comes to funds and long-term investing because we can be extremely liquid with our cash because we can literally buy and sell with a click of a button. Very easy. And the great thing about trading is it can create active income. There's no real passive income about it. It's all active income, and that's how I live my life. So that is the pros and cons of long-term investing and trading. Because a lot of people tell me like, "Oh, you really think you could beat the S&P 500 at 8% a year?" And it's like, "Well, yeah, dude, I did it today alone." And the thing is, I can be liquid. The S&P 500 is billions and billions of dollars. Okay, you can be liquid with trading. We have if you have under a $30 million assets under management or account, according to the SEC, you are a small fund. A small fund at 30 million. So basically, the what they're saying is anything above that, there's now more rules and regulations in order for you to be able to be as liquid. Because if you could trade with hundreds of millions like a normal fund would, a lot of them would, and it would really disrupt the stock market. There would be no consistency to it for the long-term investors. So that's one thing you want to know about the difference between trading and long-term investing. Now, the goal of trading. A lot of you guys think that trading is like this. Okay, this is TUP. Now, this is how I traded it. Okay, I'm going to teach you guys how I bought it before I knew it was going to go up. No, that's not the case. I did not buy here, and I most definitely did not sell here. Okay, so I want you guys to kind of rid that feeling of I need to absolutely crush the all-time low and the all-time high, and if I don't, I'm going to be very disappointed because the reality of it is you may do that one time in your career or a few times where you buy at the low and sell at the high, but the odds of you doing that consistently are slim to none. No one's going to be able to. So when it comes to day trading, what's really our goal with trading? Well, our goal with trading is to always capture a small snippet of the overall move in order to continually compound our accounts. Now I'm going to go into it in the next few slides, and what you need to be thinking is, okay, due to the theory of compounding interest, if I can consistently get 1 to 2% a day, my account will be here. Now, the problem with people expecting to squeeze the most amount of profit out of a stock is there's two main key things I find about beginner traders when they think like this. One is very FOMO based. So if hypothetically you sold here and didn't sell up here, you're like, oh shoot, well I need to now capture more of the move, so I'm going to size in up here to make up for the potential gains I could have had up here. So if it goes way up here, then I make all that money back, and that's just not the case. You're going to lose all your money. And the next thing I found is the more aggressive price targets you set for yourself and set for your trade, the riskier and less consistent you will be. So for example, if I, as a trader, was shooting for a 10% gain on a trade, then I know my win percentage should be roughly around 60-ish%, 65%, 70% sometimes. And the reason I know that is because that's the average gain I look for in a 5-minute pullback, a 10 to 15% gain. Now, when it comes to the continued momentum play, which we're going to talk about later in PCP 2.0, why is my win percentage staggeringly low? And we're looking at like a 35 to 40%. Because my average gain for a continued momentum play is closer to 30% gain. A monstrous gain, some of the best gains I've ever had. But what I found is the consistency is lower. Why? Because my price targets were higher. So there's an inverse relationship between the more aggressive price targets you have and your win percentage. So for you as a trader, we have to figure out what makes sense as far as having proper win percentage, win-loss ratios, as well as how much we can squeeze out of the stock consistently. Where should our price targets be at, right? Moving on. Now that we clearly identified our goal with trading, I guess what really is our goal? Now, what really is our goal is a few things. We already talked about the more aggressive you are with PTs, the less consistent you become. Our goal as traders is consistency. Okay, how can we be more consistent? I'm going to tell you guys, the advanced concepts that I'm going to teach you in the last week of the program will increase your win percentage. And that's why I put a win percentage backed guarantee on this, stating if I increase your win percentage by 10%, that's our guarantee. I'm going to increase your win percentage by 10%. So consistency. How do we maintain consistency between our strategies and between our trading ability? And the biggest part about consistency is really your mindset and trading. And don't worry, we are going to go over that as well. Now, this is where I really want you guys to think about trading. Okay, and the cool thing is, Braden's in the chat this morning, and what really made me think about it was I went through another trader's course about half a year ago, and it started to get the cogs in my brain turning. And then I talked to Braden 3 or 4 months ago about it, and then it really clicked with me. When you think about trading, your goal should consistently be, what is my competitive edge? So my competitive edge is my strategies, my 5-minute pullback strategies, and the strategies I'm going to teach you in this course. My PC intraday short, my historical short that makes me hundreds of thousands of dollars. That's my competitive edge. Now, what I mean by competitive edge means, what am I doing right now that's going to get me past all the competition? And we're going to talk about the next slide. And the last thing is perfect your numbers. Okay, so how do we perfect our numbers? Well, we have to constantly be doing trade review. Trading is not something you can just do on the side, a little bit here and there, make a little money, make a little moolah, and live your life. Well, a lot of people can tell you that, and I'll tell you can do trading part-time. If you really want to be the best trader you can possibly be, you need to review your numbers. Just like in business, the best businesses have a whole accounting team, so they can review their numbers, their P&L statements at the end of every single month. Your trading shouldn't be any different. You should know your numbers at the end of every single month, how you performed, what your best strategies were, what your worst strategies were, where you're making most of your money, and what you can improve on. Always, how can you improve your competitive edge? Okay, so what is my style? What is my competitive edge? Guys, I trade small cap stocks. Everyone in this chat, I think, knows that already. I'm a small cap trader. I found my best trades are between 1 to 10 million share float. I can dial that down to about 3 to 5 million if I really wanted to. Sub $200 million market cap, ideally 30 to 75 million. Generally up 20% or more. I like to put even 50% up or more now. Are my best trades. I do trade them long and short. I'm not, according to my data, I am long bias, but I think that is subject to change over the next year or so. I find I'm more consistent with my shorts. I have a much higher win percentage, and I still can maintain that 3-to-1 risk ratio. In my short only account that I doubled it in 30 days, I had a 75-ish% win percentage. I showed the statements to you guys plenty of times, so I can find them again for you. And I maintained, I think, a 3.24-to-1 risk to reward ratio. So I am about 75 long, 25% short. However, like I said, that is subject to change, I think. I think over the next year or so, that'll be about 50-50. However, all my biggest gains are always going to be long compared to short. Short, it's hard to have those big winners going short. Yes. Unless you do some sort of options, put options. And my strategies rely heavily on the Elliott wave theory and level 2 analysis. If you guys don't know what that means, you're going to learn that in the next few weeks. Now, the psychology of trading, okay? What is the psychology of it? Well, first of all, there's two main things I really think about in two stories that I like to kind of put in my brain. Now, this is Bill. We're gonna name him Bill. He's calling his wife to let him know that he just put his mortgage. He just put his mortgage on a stock, and you can see the stock's right here, and clearly they're gonna have to pull a second mortgage. So don't be Bill, okay? Don't be the guy that's going crazy. Obviously, guys. In my small account challenge, you are seeing me use my full account plus leverage in my short positions to grow it as fast as possible. That's how I was able to almost double it in a week. However, my account was down almost 20% last week. So you can see my winners and losers are going to be much bigger. And a lot of hedge funds that go under overexpose themselves due to leveraging. Have you guys ever heard of the Lehman Brothers? Anyone ever heard of the Lehman Brothers? They were a $28 billion hedge fund that went under, and they lost about 44% of their holdings in almost a single day. If you guys don't know the story about the Lehman Brothers, yes, even as a billion-dollar fund, you still can go under, and that can be a problem. They were a 25 to a 30 to 1 leverage. So, for example, they had a few $1 billion in their account, but in order to make more money, they had hundreds of billions invested. And they were trading the 29.75-year bond. Yes, that is a real bond against the 30-year bond. It was a crazy strategy, but that was their competitive edge, and they made billions of dollars doing it. Now, the cool thing about it is, for the Lehman Brothers, they made hundreds of millions of dollars before their fund went under. However, they eventually lost billions of dollars, and all their investors pulled out. Because they were overexposed, guys. They were exposed a 30 to 1 or 28 to 1. Don't be those people. Do not over leverage. Okay, number one. And another thing about that story is the Russians, they failed to pay. The Russian bonds defaulted, so everyone invested in a 30-year bond, which forced them to close their short positions and forced them to go under. George Soros almost went under, one of the richest guys in the world. So you can see these guys, if you overexpose yourself, no matter if you're a billionaire, you will eventually go under. Risk does play a part, and there's a few books I read on risk that I can recommend to you guys, but you will eventually go under if you over-risk yourself. You cannot continue to do that over the long period of time. Okay, so you have to build a consistent competitive edge and competitive strategy while maintaining proper risk to reward ratios and not overexposing yourself. And then now the last thing is, what is your competitive edge? Okay, seriously. The way I think of it is, if you walk into a casino, okay, everyone tries to have their little gambling tactic, right? You know, I do this on the blackjack. I double down on these cards and it pays out every time. You know, usually the reason why I make money, it's this sounds terrible, but usually I bring an inexperienced person to blackjack, and whenever they have a good card, I double their bet for them, and then we just okay. We'll just leave it at that. Anywho, that's my competitive edge. No, I'm just kidding. So if you guys walked into a casino and somehow there's millions of slot machines. Now, you'll never do that, so never please try this. It will never happen, ever, ever, ever. But imagine you walk into a casino and there's a slot machine that has a 51 to 49 win rate. So you win 51% of the time, you lose 49% of the time. Okay. People used to tell me, if you flipped one of these bad boys, apparently if you flip a quarter, someone tried to tell me that it's not 50-50 percentage because apparently tails has more weight on it, so heads is like 51 to 49. I don't know. But I would actually say you have a slot machine that has a 51% win percentage. That will make you a very rich person. Why? Because standing the test of time, you have a competitive edge, an over 50% win rate, and you are going to make money. If you do the same bet a million times, that will pay out 51 to 49, and you will make money. Now, that will never happen ever in a casino. That's why we have to look at the stock market to actually find your competitive edge. So always think about what that edge will be, how you can track your numbers to ensure you do have that edge, and how you can protect that edge. Okay? Does that kind of make sense, guys? Does that slot machine kind of make sense? Because obviously I don't know what the actual win percentages are of those things. They're probably, I think it's the opposite. I think it's like 49, 51 or something like that. I've never personally done slots. However, if it was the other way around, everyone would make money, right? Because if you just consistently do it over the test of time, you'll make money. And that's the same thing with trading. We don't want to solely focus on the day-to-day stuff. That's why I no longer get down on myself when I have a red day or have a red week. Last week was a bloody week for me. It was a bad week. I lost a decent amount of money. However, I told myself, listen, every trade I traded personally, there were some that I didn't think that were valid, but most trades I traded were valid. And even with a 75% win percentage, I'm going to lose. That's just a part of the game. However, standing the test of time, if I continue to do this over the time horizon, I'm going to make money. So I cannot focus on the day to day. I have to focus on 1,000 trades, 10,000 trades, 100,000 trades in the future. Where's my accounts or where my accounts going to be at? Okay. So understanding your competitive edge is the most important thing when it comes to learning how to day trade. Okay, that's all I wanted to instill in your brain today. We are going to resume live trading, see if there's anything else popping, but we are right perfectly at our 10:15 mark. So float right here. Float is the overall supply. So, for example, when a stock IPOs, they choose the float, or the market chooses the float for them. I'm not quite sure how they do that. However, that is the supply. So, generally speaking, if there is less supply and there's an increase in demand, the stock's going to skyrocket. There's a reason why Apple will never be up 40 to 50%. A lot of it is their market cap, but also it's their float. They have such a large supply, it is almost impossible to see that stock squeeze. Okay, so if we can see a stock squeeze, I want to find stocks that have a small supply. So if there's an increase in demand, the stock price would skyrocket. We saw that in a lot of stocks this morning. They were up over 100% because they had a low supply and demand, which is volume. The demand is volume. Okay. So you want to use those in conjunction with each other. And then we'll talk later about float rotations and things like that. But then market cap is you just take the float in the total float, not just the shares tradable, but the total float, and you multiply it by the stock price, and that gives you the market cap. But the float is really what we want to look at, and what I like to look at. And the reason why I put it at 1 million is because if there's too low of supply, it can get very, very choppy. Okay. Because if there's an increase in demand and there's say there's 3 bread loaves as opposed to 30, and there's 100 people that want them, well, the people are going to be fighting over those bread loaves, right? And it's going to be crazy. It's going to be hectic. It's going to be crowded. It's not going to be consistent. However, if we have a solid market where there's a decent, where the demand outweighs the float, or demand outweighs supply, there will be always an increase in price in exchange. Then when the volume flips, generally price flips, meaning demand dwindles. Okay, does that make sense? Cool, guys. Alrighty, catch you back in the live trading chat.